A violent chain reaction crash. The impact so intense that it sent an SUV flying through the air and ended with one car into a building, another on its side. News 4's Tracy Strahan is at West 204th Street and Sherman Avenue. Tracy, it is just incredible that everyone survived there.
The NYPD says the driver of that silver Corvette was speeding going eastbound on Sherman when it collided with a Mercedes-Benz, flying through the air into a parked car and a 34-year-old man, pedestrian who was hit to the hospital. And amazingly, people who live in this area say they're constantly awakened by speeding and that it's a constant problem.
Every night after 3 o'clock, nobody's sleeping over here. The same car. We make a noise, 100 miles per hour, two wheel, and look at what he passed. This is the problem. He don't listen the law, he don't listen the
It really sucks. I was hoping to Twitter.
It was, maybe setting a line in the sand area where yields are going to be a problem for them, but it's just a Band-Aid, right? There's fiscal issues going on. There's higher inflation due to the Middle East issues. And it really, if you look at where yields are today, like as your prior guests have noted, we've essentially given back all of the moves. So it really was just more of a Band-Aid than actually solving the actual issues that are causing higher interest rates.
Well, he originally also said going from the $2 billion mark to $4 billion, and then the following day, yesterday, said it could be more than $4 billion.
Moids.
Is the amount important? Does it need to be more? Is $2 billion or $4
Would line up to date me from that tweet. I was hoping I'd find my Asmongold 72-month sub, clavicular loving chud boyfriend, and we'd be happily ever after. You were posting photos on the internet for attention from men. That's what you're doing.
So yeah, I think to read our perspective is that it's the Treasury, is concerned and they are willing to try to help support the bond market in terms of not letting yields go higher. From our perspective, given some of the fiscal issues and the inflation, that's really causing yields to go higher. I mean, if oil fell and we started to spend less money, I think you'd have lower interest rates, and they might not have to resort to some of these type of issues or structures.
Right, understood. I mean, the concern here is U.S. debt, and that's why they're looking at the long-dated treasuries, right? The U.S. dollar has come down a little bit. We'll hear from Kevin Warsh at Jackson Hole next week. What are you listening for? What do you think is the plan in his mind?
Yeah, I mean, I think he needs to reset what matters to the Fed now. I mean, I think the last Fed meeting and the discussion afterwards, there was a lot of misunderstanding or not. He wasn't very clear about what they care about. It's fine to have no more forward guidance in terms of where they think the policy rates will go. There's no issues with that. But if you add the fact that we don't really know how he's viewing the current situation, the reaction function with data coming in, now we're at the lack of the lack of information, and the market can price in if it knows what matters to the Fed in terms of what they would cause them to change interest rates. But until that's the case, that's why you're getting higher volatility. So I think what we're really looking for is just Warsh kind of laying out what really matters and what they're looking for to possibly change policy, and then the market can take that information and then change the probabilities and how we think the market's going to move going forward in terms of policy rates.
Yeah, I think you make a great point, and it's something I've heard since the last meeting. What does the Fed care about when he says they'll be watching data? Which data point is most important to the Fed? And this way, then people could navigate a little better. And that lack of clarity has been something that's been discussed on Wall Street. I'm glad that you brought it up, Mike, because he said we'll keep a watchful eye. And well, what are you watching? And so I understand what you're saying. I mean, Bessent talked about what's going on in the Middle East, and he said it'll pass, and then we'll get past that. But nobody knows when that will happen. Moving forward now, when you look at how folks should be investing in fixed income, that's your forte here as head of fixed income. What do you think people should be doing in a portfolio?
Yeah, I mean, I think you definitely have to be very cautious buying bonds past 10 years, even though you have the Treasury support out that far. From our perspective, we really think that intermediate bonds make a ton of sense. Obviously I'm biased, I'm a bond manager, but if you think about where cash is paying you, and you think about where you can put together a high quality portfolio, it's going to yield you north of 5%, so significantly higher than cash, and you have high real rates, or high, relatively speaking. It's a great time to buy bonds. You couldn't have said that a number of years ago, but now you have a lot of income back in fixed income, and we do think that staying more intermediate does provide a little bit more hedging benefit versus equities if we were to get a downturn, or we have more inflation or whatever it may be that you might not get longer with longer bonds. It really is going to matter where you own bonds. Just not owning all bonds aren't going to be treated the same way going forward.
And we think about the credit markets overall. It's something you're watching, AI and tech. We even see some of these companies tapping the debt markets. Some of your thoughts on credit markets and how they are faring. I know there's a lot of margin and leverage going on as well.
Yeah, there's been a lot of issuance, the new AI news in terms of Broadcom coming to market. So, the bonds will be issued, they will clear, we'll see how they do in the secondary market. I think in general, if you look across the credit markets, you're not being compensated a ton for taking on certain types of risk. So you really have to know what you own. You have to understand these businesses. And, if you're going to be lending to some of these AI focused names, and, by nature, bond managers are pessimistic. So you really got to question if you're be owning these names past 10 years, even past 7 years, what really is going to happen, with the profitability and the cash flow. So, you really have to know what you own, because you're not getting paid a lot if you're wrong. And so, again, that's why we like the intermediate. You're kind of cushioned from possible further interest rate movements out the curve. And then if you are going to take the credit risk, you at least have somewhat more visibility, I guess, from our perspective, being a little bit shorter than what maybe you would be otherwise.
So better to go on the intermediate path for bonds, as you were noting, even maybe short term, because you're a little concerned anything long dated at this point. All right, correct. Mike, well, it's great to see you. Really appreciate it. Mike Sanders, Madison Investments, thank you. Coming up, we'll take a look at the key levels to watch in the triple Qs with Rick Ducat. Opening bell, we'll be right back.
Beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
Have you ever watched an interview and thought, I wish they had 5 more minutes, or I want to know how they discovered that hidden gem? That's exactly where Market Matters comes in. I'm Marley Caden, and our podcast is slowing things down. We're going beyond the earnings to get to the heart of the people and companies driving the global economy. If you want the full story, not just the headlines, Market Matters is for you. Subscribe wherever you get your podcasts.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com. All right, welcome back on this Friday morning. Hope you're feeling pretty great. We are looking at the triple Qs, and lead market technician Rick Ducat is with me for the week, down about 2.5% pressure on tech. Rick, some of your thoughts on these charts?
Yes, not the greatest week for the tech sector here. We can see the triple Qs up 26.3% during the past 251 trading days. Second place out of our four here, the Russell ETF IWM up 32.6% during the same period. The SPY and the Diamond down 20 and 18% roughly as well. So when we look more closely at our candle chart here, old highs 748.65 have resulted in a downward sloping trend line here that's still in play. You could also say that it has more of a broadening triangle type shape here, where our two boundary lines are increasingly pushing farther apart from each other, which suggests higher volatility. More recently as well, we have broken through an upward sloping trajectory here. Our blue trend line here, starting with these recent highs near 735, is also perhaps being broken today. We seem to be retreating back to that point now, but some horizontal levels to consider as well. 722 and 730 mark a recent gap that we saw here. Also 735, the low point before a gap to the downside, matches up with subsequent highs. To the downside here are our supportive areas. We've had a repeated floor near about 708 as well as near 702. Old support became new resistance. We can see that that has been tested once more. That's also kind of where our gap takes place here that we saw to the upside. Now our moving averages that we have here come in right around our 5-day and 21-day, right around 715 to 716 or so. So we have a confluence there that we have so far failed to take out. Our 63-day EMA near 705 in gold, our exponential moving average, would be a downside area to watch out for as well. RSI is just slightly below the 50 midline here, so a very slight bearish tilt here, so look to see if that solidifies in one direction. Volume profile shows that we have a area here that is a node 705 to 725. That's our heavy trading area. Meanwhile, our next monthly expiration here, September 18th, our yellow box, 28 days out, plus or minus 5.1% during that time frame potentially.
Okay, Rick Ducat, thank you so much. Really appreciate it. A great look there at the triple Qs. Thank you, Rick. It's time for our market meetup panel. Right now, stocks are higher. The S&P right now is gaining 28 points, and the Dow's up 357 points. Joining me, Alex Coffey and Sterling Smith. I'm so glad that you're both with us. Sterling, a moment ago when I was talking with Ted Parkhill, he was looking at some of the commodities and looking at canola, cotton, wheat on the rise, and you are looking at cattle. Let's talk about that because there's actually some news there as well, Sterling.
Yeah, we've seen a tariff relief on 300,000 metric tons of beef for import into the U.S., and this should provide a little bit of relief to the consumer. That works out to about a pound per, consumption is about a pound per person, and this works out to about 2 pounds per person. So this will provide a little bit of temporary relief, and it is having an effect on the futures, as you can see there, as we are sharply lower. We have seen boxed beef prices ease a little bit in the last couple of months, and that is a little bit of relief for the consumer. The structural problems remain the same, though. The beef herd is the smallest since 1951, and it's going to take years to correct that if it can ever be corrected. So while this will provide a little bit of a break, I don't see this as being a long-term fix to the problems we have in the cattle market.
Okay, so for the next 90 days, allowing beef to come into lower prices here at home when we have a shortage of livestock and such. Alex, what are you watching here as we see some up arrows for equities?
Yeah, NASDAQ's on the verge of turning red here. I think is pretty fascinating. It's continued to be quite heavy. And this despite some of the sectors that are really tied to the AI infrastructures area, kind of doing okay today. You look at names like Micron higher, you look at names in semiconductors broadly doing quite well. The NeoCloud